Good morning. Thank you all for joining us today for this event. Let me be the first to welcome you to our symposium, Tax Advice for the Second Obama Administration. My name is Margot Parmenter, and I am the editor-in-chief of the Pepperdine Law Review, who, along with tax analysts, is co-sponsoring this event. In just a moment, I'm going to introduce our preeminent dean, Danelle Taha, to really kick off the event. But before I do that, I just wanted to take a moment to extend a thank you to some of the people without whom this event really would not have been possible. So first, I just wanted to extend a really warm welcome and a large thank you to tax analysts, our co-sponsor for this event. Without them, we really would not have been able to put on a symposium on this level of this magnitude. So welcome to all of you, and we're very happy that you're here joining us today. Second, I want to thank all of our speakers. We're very excited that all of you came out to participate in this important conversation, this really interesting topic. We're very excited about that. And the Pepperdine Law Review is very excited to publish all of the pieces that have been submitted by authors in our May 2013 special issue of the Pepperdine Law Review. And finally, I want to extend a large thank you to Professor Paul Caron, who is really the architect of this event. Without him, none of this would be happening. And without further ado, Dean Taha.
Thank you, Margot, and that's an example of the kind of great Pepperdine students that we have. Thank you, Margot. I want to also say thank you to Michael Wood, who has been the symposium coordinator and done just a magnificent job. Well, welcome to Pepperdine, welcome to Malibu, and welcome to a law school that is really on the rise. We are so proud to have you with us today. It is fitting that it is inaugural weekend for the second term of the Obama administration, and because Professor Caron, I am actually counting the days that mark when he ends being a visitor and starts being a permanent faculty member at Pepperdine, because we are proud to welcome him to our ranks, and we are committed to making tax and tax policy one of the centerpieces of our work here at the law school. It is no accident at all that we are here on this inaugural weekend, and that we have gathered you, the nation's leading experts on tax policy, to talk with us and to publish with us on the critical issues facing the American people, our leaders, and I think it's fair to say the academics who will help lead this discussion. And you are gathered in this room. So we are deeply grateful to all of you and to tax analysts for being our partner in this. I think it is fair to say that in higher education, on all topics these days, it is critically important for us to partner with the private sector, partner with policymakers, join together, if you will, so that the good thinking doesn't just rattle around in the ivory tower, but rather becomes very much a part of what we all do and how we all feel the impact of policy. So to tax analysts, I'm deeply grateful, and I think you have quite a few people representing you here today. Would you stand, the tax analysts, folks? Let's give them a big hand. And now it is my distinct pleasure to introduce the other dean, the Dean of Tax Analysts, Christopher Bergen, who has been, I think it's fair to say, one of the most prodigious writers on tax policy, both in hard copy and on blogs. He seems to know everything about tax, which to a sort of garden variety Article 3 judge seems kind of amazing. But Chris, I respect and deeply, deeply humbled that you are here and that you are with us. You can find his postings almost everywhere, but among them, the New York Post, America's Public Media's Marketplace Morning Report, C-SPAN, the Seattle Times, I could go on and on. But today, it's the Pepperdine Law Review, and we're delighted to have you.
Thank you, Dean Taha. Whatever I know about federal tax, not sure how much that is, I learned from people in this room who you're going to hear from. Thank you again, Dean. Thanks to our co-sponsors, the Pepperdine Law Review, for your warm welcome and most gracious hospitality. I want to thank Margot and Michael specifically. You folks have made this so easy for us, and we have brought several people with us from Virginia today. Thank you. It's been a breeze. And my thanks again to Professor Paul Caron. We've worked together for some years, and this is his brainchild, and we're happy to sort of hook our wagon onto it. Thank you, Paul. On behalf of tax analysts, I can say for all of us, it's wonderful to be in this wonderful place. Now, I knew about this wonderful place because I lived in California for about 5 years in a prior life, but I must tell you, I've forgotten how beautiful it truly is. And thank you, Dean, for the weather that you arranged.
You're welcome.
Because it's gorgeous. So, good morning. I bring you greetings from Washington, D.C., which is where we work. At least as far as tax policy and tax politics goes, they've gone crazy. And I've been doing this for more than 30 years. I've never seen them this crazy. And that's why Tax Analysts is thrilled to be co-sponsoring this conference, because Washington needs all the help it can get. And it's not going to get it from inside the Beltway. That's become apparent. And there's a terrific lineup here, as the Dean has stated. There are some real luminaries in this room that you're going to hear from today, which is why I'm going to get out of the way very quickly. And I guarantee you, you will enjoy what they have to say. And what they have to say is very important. Now, for those of you who may not know who Tax Analysts is, we are a nonprofit organization that have worked for more than 40 years, actually headed towards 50, for tax systems that are fair, simple, and economically efficient. And we also work for tax administration that is transparent, which has gotten us into more than a few scrapes with the Internal Revenue Service over the years, using the Freedom of Information Act. If you look in the case law of the Freedom of Information Act, you will see most of the cases have our name on it. And now we're bringing that transparency campaign into the states with some acceptance, and some not so good. Tax Analyst is also a global publisher of tax news and analysis and commentary used by more than 250,000 tax professionals around the world. We are relentlessly in the pursuit of truth when it comes to our journalism. From the halls of Congress, to state judges around the country, to international policymakers, even to the White House, our experts are cited as providers of essential information. You will hear from several of them today. It's also a very cool place to work. So, as you said, Margo, without further ado, Professor Paul Caron.
It is my honor to introduce now one of the real giants of the tax law in more ways than one. Since about 2009, Michael Gratz has been the alumni professor of tax law and the Wilbur H. Friedman professor of tax law at Columbia Law School. Prior to that, for about 25 years, he was the Justice Hotchkiss professor of law at Yale Law School. He got his academic career started, though, here in Southern California, beginning from the late 1970s to the early 1980s. He was on the faculty at Caltech and USC. Tax law has a history of having academics who travel not only in the academic world, but also in high levels of government and private practice, which Michael has done. He's the former Deputy Assistant Secretary for Tax Policy. He consults widely with our firms and other groups, and in fact, this morning has just filed a brief in the United States Supreme Court. He's written over 60 articles and many books. Two of the most influential that he's written in recent years. The first is 100 Million Unnecessary Returns, which is widely acclaimed as one of the most important tax reform ideas in circulation. His book, Death by a Thousand Cuts, is easily the most influential book on the politics of the estate tax. But despite all of his professional accomplishments, Michael is a humble man. I checked his CV, and nowhere on there does he mention his most significant and enduring professional accomplishment. Back in 1987, he taught Robert Pashar of our faculty tax law. So join me in welcoming Bob Pashar's tax professor, Michael Gratz.
Thank you, Paul. It is a great pleasure to be introduced by the man who, along with tax analysts, serves as, I think, the greatest public servant to the tax professional community through his blog. Paul may not like my putting it this way, but he and I are now codependent. And I want to thank Dean Taha and the Pepperdine Law School and the Pepperdine Law Review for sponsoring this conference, and especially to Paul and Michael Wood, who did make things remarkably easy for everybody. And I am looking forward to the panels for the rest of the day with many of my good friends and colleagues, and I think it's a great session that has been planned. So you've asked for our tax advice for a second Obama administration, and I will certainly get to that. But I want to begin by noting that this year marks the 100th anniversary. We are celebrating, if that is the right word, the 100th anniversary of the modern U.S. income tax. Then, as now, economists played a particularly large role in shaping this nation's understanding and furthering the enactment of the income tax. Lawyers then, less so. So let me mention two economists, both founders and early presidents of the American Economics Association. The first was Richard T. Ely, who in a 1988 book described the income tax, quote, as the fairest tax ever devised. The second was Columbia's Edwin Seligman, who argued that the income tax was essential, quote, to round out the existing system in the direction of greater justice. Elliot Brownlee, who is the most important tax historian of this era, described the crucial role of economists in helping to, quote, shift the discourse over taxation to an emphasis on a moderate redistribution of the tax burden. To many economists today, but not all, their predecessors' focus on a fair distribution of the tax burden no doubt seems quaint and even archaic, perhaps even inapt. But make no mistake, achieving greater tax equity, greater tax justice, is what the 1913 adoption of the income tax was all about. The culmination of a two-decade, broad-based, popular effort to achieve greater fairness in our nation's tax system, one that required the extraordinary support of the American people necessary to amend our Constitution. Enactment of the 16th Amendment, of course, did not end the debate. From the White House, the former Princeton political scientist, Woodrow Wilson, presciently observed in September of 1913, quote, individual judgments will differ with regard to the burden it is fair to lay on incomes which run above the usual levels. as we have witnessed last month in the debate over the fiscal cliff. A century later, those differences and those judgments remain at the center of U.S. political debate. Now, if we were to ask one of our students, why does the U.S. have an income tax? They would no doubt respond, because we need the money. And that indeed explains the origins of the nation's first income tax, the one enacted 150 years ago in 1863, after Treasury Secretary Salmon Chase told President Lincoln that the Union government couldn't borrow enough money to finance its war debts. A doleful truth that the Confederacy failed to learn until it was too late. But by 1893, revenue needs no longer accurately capture our nation's movement to tax income. In fact, as Elliott Brownlee recounts, virtually none of the income tax proponents within the government believed that the income tax would become a major, let alone the dominant, permanent source of income, of tax revenue, within, as he described it, the consumption-based federal tax system. He insists, support for a progressive income tax had far more to do with the search for social justice in an industrializing nation than with the quest for an elastic source of income. He concludes that the revenue goals of the tax were far less important than the desire to use the tax to advance economic justice. The income tax enacted in 1913 was both less progressive and less ambitious in its revenue goals than the previous Civil War income tax, or the 1984 income tax, which had been struck down by a conservative Supreme Court in the Pollock case. In his excellent book, The Great Tax Wars, detailing the 50-year struggle over income taxation that culminated in the 16th Amendment in 1913, the journalist Stephen Wiseman describes the political battle as one between justice and virtue, with proponents of the former insisting that it was fair for society to tax income at graduated rates according to ability to pay, because of some need to establish some level of social equity and to curb the power of great wealth over government. And those on the other side countered that allowing citizens to keep the wealth that they earned was vital to the spirit of free enterprise. The claim of income tax opponents was that taxing wealth, quote, wrecks the incentives that have fueled the engine of American prosperity. Sound familiar? A century has passed, but the debate is essentially unchanged. Importantly, notwithstanding the ups and downs of marginal tax rates, a progressive rate tax on income has been a key element of American tradition for 100 years. Advocates for virtue, those most concerned about incentives, peaked more than 8 decades ago in 1932, when Andrew Mellon succeeded in reducing the top marginal income tax rate from its World War I high of 77% to 24%. Half a century later, Ronald Reagan nearly managed to duplicate that feat, moving from a 70% top income rate when he took office in 1981 to a 28% rate when he left 8 years later. Now the top rate is back up around 40%. The income tax was transformed when our nation faced massive revenue needs for World War II. Then, for the first time,
our nation became one of income taxpayers. According to Brownlee, in 1939, less than 4 million Americans paid income tax, but by 1945, that number had increased tenfold to more than 40 million. Income tax revenues rose during that same period from $2.2 billion to $31.1 billion. By the time World War II came to an end, individual income taxes accounted for 40% of federal revenues, and corporate taxes contributed another third. For the 7 decades since, the income tax has remained the centerpiece of the United States tax system. But now everyone agrees that our current system is broken, that it is overly complex, that it causes too many unwise distortions in people's decisions, and that it could be made far more conducive to economic growth. 2 years ago, many tax publications, including tax analysts, celebrated the 25th anniversary of the Tax Reform Act of 1986, the last major U.S. tax reform. Legislation that many, including the Bowles-Simpson Fiscal Commission, have urged that we use as a template for tax reform now. It was surely the crowning domestic achievement of Ronald Reagan's presidency, and that legislation was widely heralded as the most important tax legislation since the income tax was converted into a tax on the masses during World War II. Since pundits and politicians from across the political spectrum are now calling for a replay, it is worth taking a few minutes to review what happened then. The 1986 tax reform increased the permissible amount of tax-free income. It lowered and flattened income tax rates, shut down mass-marketed tax shelters for high-income individuals, curtailed the ability to shift income to lower-income, lower-rate family members, and tax capital gains at the same rate as ordinary income. By shutting down tax shelters for individuals and repealing tax benefits for equipment and real estate, Congress not only financed a reduction in the corporate rate from 46% to 34%, but also paid for some of the individual rate reductions. The corporate changes also made the income tax considerably more neutral across industries. Soon thereafter, the law's rate-reducing and base-broadening reforms were mimicked throughout the OECD. But the changes that the 1986 Act wrought have proved neither revolutionary nor stable. The 1986 Act resulted from an uneasy marriage, a temporary marriage, between the forces of justice and virtue. The conventional tax reformers, who are principally interested in improving tax equity by broadening the income tax base so that income would be taxed similarly regardless of its source, joined together with supply-siders and deregulators who were most concerned about incentives and wanted to enact lower tax rates to get government off the backs of the American public and American businesses. The ink was hardly dry on the 1986 legislation before divorce proceedings started. Thousands of pages of legislation in the years since have narrowed the income tax base while the top rate has crept upward. Even though deficits were becoming a great concern by the 1980s, the linchpin of the 1986 Act was revenue neutrality. By insisting on revenue neutrality, the Reagan administration and the congressional leadership were able to insist that amendments to the tax bill could only be offered if revenue losses were offset by revenue gains. And legislators behaved quite differently when to pay Peter, they had to be explicit about how they intended to rob Paul. Tax reform was not only revenue neutral, but was also distributionally neutral. So the '86 Act was not an occasion for significantly shifting the distribution of the tax burden among income classes. Distributional neutrality, along with revenue neutrality, became the guiding principles for this legislation. Most importantly, Ronald Reagan rejected almost unanimous calls from economists and some law professors to move away from income taxation to taxing consumption. Today, conditions are very different. First, neither revenue neutrality nor distributional neutrality will likely suffice for very long. Given the size of the national debt and projected increases in that debt for the near and long-term future, it seems essential for tax reform to be capable of producing additional revenues going forward. But since this state adopted Proposition 13 35 years ago, antipathy to taxes has served as the glue that has held the Republican coalition together. So revenue increasing tax reform will be extremely difficult, if not impossible, politically. Second, given the rise in inequality, especially the increase in the shares of income and wealth concentrated at the very top, some of our political leaders will not be willing to settle for distributional neutrality even after the fiscal cliff settlement. They will argue that tax reform should make the federal income tax more progressive. Third, and very importantly, there is no pot of gold from which to finance tax reform. In 1986, as I have said, repeal of tax benefits for investment in plant and equipment and limitations on individual tax shelters, along with the elimination of lower rates for capital gains, financed much of the rate reduction for both individuals and corporations. Now, however, given the internationalization of economic activity and increased competition from abroad, repeating the 1986 Act's reliance on increased taxation of corporate income is not, in my view, possible. Corporations and others holding large amounts of capital move money quickly and easily around the world, making it much more difficult for any nation, including the United States, to tax their income. And because of large pools of private capital, including sovereign wealth funds and private equity funds, large partnerships now account for an unusually large share of business income. And this further complicates the quest for business tax reform. Technological advances also allow the ownership of valuable intellectual property to be moved around the world with a click of a mouse, and financial innovation, along with differences in tax rules among nations, facilitate tax planning opportunities. The interdependence of the world economy makes trying to impose high income tax rates on multinational corporations and business partnerships counterproductive. Deductions flock to high-rate countries, income flocks to low-rate countries. There is only so much the United States can do unilaterally to address this problem. In order to attract capital to create better conditions for American workers and businesses, the United States must be an attractive place for both foreign and domestic investors. And American companies need to be positioned to take full advantage of the global markets for goods and services, labor and capital. I have come to believe that absent broad international agreement and cooperation among countries, foregoing international tax competition, a transformation that does not seem on anyone's horizon. A low statutory corporate tax rate is essential. This year we have the highest statutory rate in the developed world. The substantive difficulties of designing sound corporate income tax policies for today's global economy are difficult enough, but taking political considerations into account makes the task positively Herculean. Corporate income taxes are popular with the public despite the virtually unanimous view among tax policy analysts that the corporate tax is a bad tax economically. It is child's play to characterize large corporations, especially large multinational corporations, as villains. This is probably why the public seems to love a tax that economists hate. But high tax rates on corporate income in today's global economy are a bad way to achieve either economic growth or to obtain and maintain progressivity in the distribution of the tax burden. So the corporate tax should not, and as a practical matter will not, be able to be used to finance tax cuts for individuals. At most, reforming corporate income taxation will itself be revenue neutral. Nor can tax reform be financed through more borrowing. That was George Bush's trick back in 2001, and it has been all used up. That year, Alan Greenspan famously told Congress that our surpluses in the years ahead were so high that we would have to pay off all of our national debt and the government would have to start investing in corporate stock, an idea that he abhorred. Well, the good news is that problem has been solved. Our national debt is now larger as a share of our economy than at any time since World War II, and then 95% of our debt was owed to Americans. This time, there is no pot of gold to finance tax reform unless it is hiding somewhere under a rainbow. People talk about broadening the tax base and lowering the tax rate, but here is the ugly truth. The 1986 legislation did not induce Congress to forsake the income tax as its blunt instrument to serve non-revenue raising purposes. Presidents and members of Congress from both parties continue to act as if an income tax credit or deduction is the best prescription for virtually every economic and social policy our nation faces. In the process, the Internal Revenue Service has become the administrator of many of the nation's most important spending purposes. And if you doubt this, I commend to you the most recent tax legislation. To keep track, as we know, of all these tax benefits, the government publishes a list of so-called tax expenditures, a list which has almost doubled since 1986. And we know that once enacted, no matter how ineffective or distortive, these expenditures tend to stay in place. Their total cost in lost revenues is estimated to exceed $1 trillion a year. But here is the rub. These are not just narrow special interest tax loopholes. The biggest items are tax breaks widely available to broad segments of the general public. The largest tax expenditures are very popular. Tax advantages for employees, payments for health insurance and retirement savings, deductions for home mortgage interest, state and local tax deductions, charitable contributions, low and zero rate on capital gains. No politician likes to admit it, but if tax reform is to be financed by broadening the income tax base, these are the tax breaks that will have to be eliminated or at least sharply curtailed. Marty Sullivan, in a Tax Notes article just this week, showed that what he described as an aggressive tax reform plan, I would describe it as very aggressive, would only finance a 10% reduction in tax rates across the board, a reduction of our 40% rate to 36%, and the bottom 10% rate to 9%. Hardly the kind of change to wage a political career on. Sadly, I have come to regard the 1986 Act as a promise failed. I do not believe that the best path for tax reform is simply to improve the income tax. Changes in the last 25 years make this a dead end. And as we now know, it does not take very long after a good cleansing of the income tax for the law to get very dirty again. Many of the 1986 reforms have been reversed. Its broad base and low rates have been transformed into a narrower base with higher rates. How can anyone remain optimistic about fixing the income tax without radical surgery? Joel Slimrod has recently observed that when people are young, we celebrate their birthdays with enthusiasm. But when they approach 100, we begin to think maybe it's time for them to move on. That is the state of today's income tax. Although few noticed it, the most recent big push for tax reform occurred just 8 years ago in 2005. 2 weeks before his second inauguration, in January of that year, George W. Bush established a 9-person tax reform panel headed by former Senators John Breaux and Connie Mack, Republican of Florida and a Democrat from Louisiana, to fulfill Bush's campaign promise to lead a bipartisan effort to reform and simplify the nation's tax law. The panel's 272-page report, issued in November of 2005, endorsed either and 5 minutes remaining, maybe I'll take 6 or 7, you may not get me out of here in 5, but no more than that. The panel endorsed a comprehensive income tax reform, or alternatively a tax modeled on David Bradford's X tax, which it called a growth and investment tax, which had also a scheduler tax on capital income. In 2006, a few months after the report was issued, John Breaux was in the Oval Office and he was opening cabinets, and George Bush asked him, "John, what are you doing?" Breaux said, "I'm looking for my panel's report, Mr. President." He was right. This report had disappeared into oblivion. But in fact, the panel's report injected some needed political and practical reality into our tax reform conversation. And I want to emphasize 2 of its most important conclusions. First, after careful consideration, this quite conservative panel rejected both the flat tax and a national sales tax, the 2 most popular ideas with House Republicans. In doing so, the panel concluded that continuing to tax capital income was essential for the American people to regard any tax reform as fair. Second, and equally importantly, the panel concluded that any consumption tax must be border adjusted to function properly, that regardless of the economics, border adjustments were essential to tax compliance, a conclusion I agree with. Then, surprisingly, the panel endorsed a unique form of consumption tax, as I said, a form of David Bradford's X tax, that would not only have to be enacted by Congress, but that would require renegotiation of all of our income tax treaties and our trade treaties. This, I think, was a colossal mistake that inevitably consigned this panel's recommendation to history's dustbin. Today's tax reform challenge is daunting: to reduce deficits and debt in the long run and simultaneously to achieve a fair distribution of the tax burden, promoting our nation's economic growth. The fundamental problem is that in today's international economy, the United States can no longer afford to rely so heavily on income taxation to finance federal expenditures. Our nation needs a better and new tax system, one that is simpler, fair, and much more conducive to economic growth. No one who has read my work will be surprised what my advice is for the second Obama administration. Ironically, or perhaps magically, it is to return our nation's tax system to look more like the one in 1913. The United States is a low-tax country, but we are not a low-income tax country. Our income tax takes a share of economic output similar to other nations. The big difference is that we are the only OECD nation without a national level tax on sales of goods and services. Reforming the income tax will do nothing to change this fundamental economic disadvantage. After the Second World War, when the United States had virtually all the money there was, with Europe and Japan in a shambles, and China beginning to enter a dark communist period, even a horrible tax system with income tax rates up to 91% could not impede our success in that world's economy. This century, we can no longer afford to so hobble ourselves. We need to restructure our tax system if we want to succeed in today's global economy. I have shown that it is quite practical to combine a tax on sales of goods and services with an income tax on higher income individuals that is at least as progressive as current law and that raises at least as much revenue. We need to reunite virtue with justice by moving back toward the mix of consumption and income taxes that we had in 1913. I have shown how this can be done in my book, 100 Million Unnecessary Returns. With a grant from the Pew Charitable Trust, the Tax Policy Center has estimated my plan. Here is what they concluded. A 12% tax on sales of goods and services, 12.3%, could fund a $100,000 exemption from the income tax, removing more than 150 million Americans from the income tax rolls, making this system revenue neutral with a distribution of the tax burden similar to that of current law, with a 15% corporate income tax rate, could be accomplished with an income tax rate of 16% on income between $100,000 and $200,000, 25.5% on income above $200,000. After the fiscal cliff legislation, which they did not take into account, needless to say, you might need another 30% rate on incomes above $350,000 to $400,000. A debit card, which I will not describe given the lack of time, and payroll tax offsets can be used to protect low and moderate income people from a tax increase. Small businesses with $1 million or less of sales can be exempt from having to collect the goods and services tax. And I was very happy when the Tax Policy Center found that this plan would reduce 111 million tax returns. I would have been a bit embarrassed had it been 95. Gearing up to implement such a consumption tax might take the IRS and businesses up to 2 years. But experience elsewhere shows that during this interval, Americans would accelerate their purchases of large consumer ticket items such as cars and appliances, providing a short-term boost to our economy. Over the longer term, such a tax reform would make the United States a much more favorable place for investment, savings, and economic growth. Most Americans would owe no tax at all on their savings, and everyone would face lower tax rates on savings and investments. The vast majority of Americans would never again have to deal with the IRS. This tax reform would also make the U.S. a much more attractive place for corporate and other business investments. Importantly, and unlike other consumption taxes that have captured so many economists' imagination, my plan fits well with international arrangements. This system would solve the problem caused by international tax planning by multinational corporations, and consistent with our obligations under trade treaties, it would tax imports and exempt exports, yielding hundreds of billions of dollars of revenue to the U.S. Treasury in the decade ahead. By returning the income tax to its pre-World War II role as a relatively small tax on a thin slice of upper-income Americans, there would be no temptation for Congress to continue to use tax breaks as if they were the solution to America's social and economic problems. We have tried that, and it doesn't work. The 1986 Act gave our income tax a good cleansing, but its ink had hardly dried before Congress started enacting new tax breaks and raising rates. A replay is simply inadequate now to address our nation's economic and fiscal challenges. A dramatic reform that uses a goods and services tax to reduce our nation's reliance on income taxation, I believe, is the only path forward that will once again accommodate both virtue and justice and enhance economic growth without abandoning tax equity. What we need now is a major overhaul of our nation's tax system, not just another oil change and lubrication. Thank you.
Thanks, Margot. Oh. Thanks, Margot. Good morning. First of all, I don't know who arranged this. I don't know why we have to follow Professor Gratz. That seems like a pretty hard act to follow. But our panel assures me this is going to be the best panel of the day, so we're very excited. It's an honor and a privilege to be here today, and I want to thank as Chris said, tax analysts are very excited about this, and we want to thank again Pepperdine Law School and the Law Review, and in particular Margot and Michael for being such gracious hosts. I think we have a terrific opening panel today. Our speakers are truly among the leading thinkers in tax practice and policy, and I'm going to introduce them in the order they're going to speak. They're going to speak for 12 minutes, and then we're going to have a brief Q&A session afterwards. Professor Dorothy Brown is with Emory University. She's a nationally known scholar on race, class, and tax policy. Her paper and presentation I think you will find provocative, which is good. Francine Lippman will speak next, is a chair professor at UNLV's Law School. She has a great mix of business, law practice, and academic experience. And I think you will find her paper provocative. Kirk Stark is a professor and the dean at UCLA, and he has a wide range of tax interests, particularly known, as far as I'm concerned, for his work in the state and local field. And his paper, which was co-wrote with Eric Zolt, I believe, is that correct, Kirk? Yes. Who is not with us today, also a professor at UCLA and a member of the board of directors of tax analysts. His paper is also provocative, so we went 3 for 3, which is very exciting. Our commentators are equally impressive. David Miller is a partner at Cadwalader in New York City and widely considered one of the leading tax practitioners in the nation. And then last but not least, Bruce Bartlett, who has a wealth of government experience on the Hill and has served 2 presidents, is a columnist for the Fiscal Times, and more importantly, a regular columnist for Tax Notes magazine. And I have to tell you, he is one of the most respected and influential observers and commentators on fiscal policy in the country. So without further ado on my end, I'm going to turn this over to Dorothy.
Thank you. I'd also like to thank Dean Daha and the faculty at Pepperdine Law School, especially my former colleague, Paul Caron, for inviting me to participate in this very exciting symposium. I also have to thank the symposium editor extraordinaire, Michael Wood, who I've decided I will not do any other symposia until they put him on a consulting contract, because he has run the most efficient process I have ever seen. I am in awe. The title of my apparently provocative paper is The 535 Report, A Pathway to Fundamental Tax Reform. Recently, both houses of Congress voted for, and the president signed, the continuation of the Bush tax cuts for all but the highest income wage earners. But if you think the fiscal cliff deal was a good thing for the middle class, as President Obama promised, think again. The extension of the Bush tax cuts does nothing to change the fact that most middle and low-income earners do not benefit from the tax breaks, loopholes, and deductions that Congress preserved for the highest income Americans. Warren Buffett will still pay a lower effective tax rate than his secretary. The recent election showed that race matters, but guess who stands to lose the most from the deal? Taxpayers of color. Lost in the discussion during the recent fiscal cliff negotiations was whether a continuation of current law would be a good idea for taxpayers based upon their race and/or ethnicity and class. Current law that creates those breaks, loopholes, and deductions reflect congressional choices about whether income will be taxed, at what rate, and whether something I just paid for is deductible. As it turns out, most whites, most blacks, most Asian Americans, and most Latinos do not get the benefit of those congressional choices. The price that most of us pay for the deductions and loopholes and special deals received by a small, high-income slice of mainly white Americans is higher tax rates. If deductions and special deals were eliminated, marginal tax rates could be cut by as much as 10 points for all but the lowest income wage earners. That would mean a simpler and fairer tax code for all. It would also mean that the highest income households would pay a great deal more in taxes. Most Americans lose under the current system, yet the system continues. What would it take for change to occur? I argue that members of Congress are disproportionate beneficiaries of the choices they enact into law. I don't know this for a fact because members of Congress are not required by law to disclose their tax returns, and very few do. I argue that the first step for meaningful tax reform will be for the Internal Revenue Service to issue a report on the 535 tax returns of every member of Congress. There is precedent for this type of report. Currently, the IRS annually issues a report on the tax returns of the top 400 highest income individuals. Bold reform, which eliminates loopholes, deductions, and special deals as a means to lowering tax rates in general, would help the majority of taxpayers, white and non-white alike. A blueprint for this already exists. In December 2010, the Bipartisan National Commission on Fiscal Responsibility and Reform, I say Simpson-Bowles, Michael says Bowles-Simpson, issued a report that showed how tax rates could be cut by significantly for all but the lowest income bracket. If taxable income were viewed more broadly, there was no special rate for capital gains, and deductions were significantly modified or eliminated. This morning, I will consider 3 congressional choices: the exclusion from income for employer or union-provided pensions, the preferential rate for capital gains, and the mortgage interest deduction. Wages placed in pensions along with income earned is not included in taxable income. The estimated revenue lost in 2013 from those wages and earnings not being currently taxed is projected to be $147 billion. The data show that most workers of color and most white workers do not receive this tax benefit. According to the Employee Benefits Research Institute, less than 4 in 10 black, less than 4 in 10 Asian American workers, and just over 2 in 10 Latino workers participate in their pension plans and receive this benefit. Just over 4 in 10 white workers participate in their employer union-provided plan and receive this benefit. The majority of workers do not benefit from this tax break, either because they do not have a job that comes with this perk or they choose not to participate. Next, let's consider the congressional choice to tax income from stock at a preferential rate when compared to that applied to wages. This, of course, is why Warren Buffett's tax rate, effective tax rate, is lower than his secretary's. Most of his income comes from stock, and most of hers comes from wages. Less than 1 in 10 Americans of color own stock in a way that makes them eligible for the preferential rate. Less than 2 in 10 white Americans own stock in a way that makes them eligible for the preferential rate. In 2012, 71% of capital gains and corporate dividends went to the top 1% of American households. The majority of Americans never pay the low preferential rate associated with stock ownership. Next, I consider the congressional choice to allow a tax deduction for mortgage interest, which you can receive on up to 2 homes as long as your mortgage doesn't exceed $1 million. For 2013, the estimated revenue loss is expected to be almost $90 billion. By comparison, the entire HUD budget is less than $50 billion. 2/3 of Americans do not itemize deductions and get no tax advantage from any choice Congress makes with respect to deductions. The majority of blacks and Latinos are not homeowners and are not eligible for the mortgage interest deduction. A recent study showed that only 29% of all tax returns filed claimed a mortgage interest deduction. While the majority of whites and Asian Americans are homeowners, the majority of Americans never receive the benefit of this deduction. My tax reform proposal is similar to, but more aggressive than, Simpson-Bowles. I argue for repeal of exclusions, like the wages placed in employer-provided pensions. Simpson-Bowles does not. Wages placed in employer-provided pension should be included in employees' gross income and taxed when earned. I argue that income from stock should be subject to the same rate of tax as income from wages. Simpson-Bowles shows that marginal tax rates can be lowest if income from stock is taxed at the same rate as income from wages. While Simpson-Bowles argues for converting the mortgage interest deduction into a tax credit and limiting the maximum amount of a mortgage to $500,000, I argue for its repeal. The majority of taxpayers are not eligible for any of these tax breaks. They should be repealed in exchange for lowering tax rates by up to 10 percentage points, which would benefit most taxpayers. Finally, I know my timekeeper is happy I said that. Finally, we get to the hardest part. How could my proposal ever become law? Conventional wisdom says that Congress passes laws to benefit the rich because the rich are the primary source of their campaign contribution. If that's true, then we should never expect change. We have a classic collective action problem. The rich are a relatively small yet highly motivated group versus the general public, which is diffuse and not engaged or focused. What we need is what political scientists call a focusing event. That focusing event will be the issuance of and media coverage surrounding the 535 report. The 535 report, which I am proposing, will be a study of the IRS undertakes of congressional tax returns with the notion of examining the tax returns and comparing them to how Americans generally take deductions or don't take deductions, looking at how Congress behaves on their tax returns versus the average American. The IRS, as you know, publishes statistics of income on all tax returns, and we can then compare the percent of congressional beneficiaries with the percent of ordinary Americans who benefit from the various loopholes, special tax rates, and deductions. I predict that after the 535 report is released, the public will get angry. And Congress, even more concerned about primary challengers, will embrace tax reform that is good for most Americans, even if it is bad for them. I conclude on an optimistic note. The recent presidential election saw a successful hedge fund manager lose. Money can't buy everything. Fundamental tax reform is still possible. Thank you.
Thank you, Dorothy. Francine, you are up.
Good morning. Sorry, law review students. I too want to echo all the thank yous. Michael Wood and your team, you've been hardworking, detail-oriented, diligent, and excellent at nudging and herding the cats. These attributes will serve you well for the rest of your lives. And I can think of no better role model in these attributes than Paul Karen, the tax prof. His blog has actually created a cyberspace community that has advanced my own work and put me in touch with people across the globe. So thank you, Paul, for your unbelievable, tireless, unrelenting work. And in fact, it's actually, though, thank you for this conference, Pepperdine and Tax Analysts, because while cyberspace and the blog is fabulous, actually seeing people in the flesh is quite unique, and it has, sorts of benefits. Pepperdine University and Tax Analysts, thank you for your generosity. And Pepperdine, thank you so much for bringing Paul Karen to the Pacific time zone. We appreciate that. I am really looking forward to talking to you about my topic today. And I'm not going to talk as much about tax to a room of tax experts. I want to talk about a different topic. But I have been thinking about researching and writing in an area of access to tax justice. And I also have had the privilege of doing this. And I encourage each and every one of you in this room, especially the Law Review Symposium students who are now in the overflow room, to think actively about engaging in providing pro bono tax service. The good news is, and the bad news is, there are countless clients. While it doesn't pay to get into your pocketbook, it will enrich you for the rest of your lives. So what is tax justice? Well, Congress, for the last many decades, has enacted billions, hundreds of billions of dollars of tax provisions through the Internal Revenue Code that are providing justice. These provisions are diverse and many, including the first-time home buyers credit, economic stimulus, the earned income tax credit, which is the primary focus of my work and also of this paper. So, how have we been doing on the earned income tax credit? As you may or may not know, the earned income tax credit is the largest and most successful cash assistance program to the working poor. So, I'm going to use it. I'm going to use that four-letter word that nobody used during the campaign debates, nobody used during the election, and many poor poverty law experts were very concerned. Some, though, have argued that economic inequality and income inequality is a way to spin it, is a way to sell this, because we don't want the middle class to go to war against the poor over limited resources. But I want to talk about poverty, and I've been spending a lot of time looking at the statistics because they are alarming. 1 in 6 Americans live in poverty in this country. 46.2 million individuals. That is the highest number in the history of this country. The good news I can tell you is the 2011 statistics as compared to the 2010 statistics we did not increase statistically, so we have come to a plateau, hopefully maybe for a moment in time. So obviously the population has grown over time, but what is interesting is the percentage. So what's the percentage? Well, the official poverty rate, and again, how do you define poverty, is about 15%. If you look at the supplemental poverty measure, it's about 16%. 2011 is about the same as 2010. People of color are disproportionately impacted by poverty, and while living $1 above the poverty level certainly is not going to be comforting, these statistics I also think are misleading. Because if you look at who is living at 250% above the poverty level, we are talking about 133 million Americans. That's about 45% of the country, of the population. And 250% of the poverty threshold. So what is the poverty threshold? Well, for one person, it's $11,500. For a family of four, it's $23,000. Now, what's included in that number? It's interesting because we don't include in the poverty threshold taxes. So that number does not include benefits like the Earned Income Tax Credit. It also does not include food stamps, although we don't call it food stamps now, we call it SNAP, Supplemental Nutrition Assistance Program. That's the new acronym, SNAP. So it doesn't include SNAP, it doesn't include the Earned Income Tax Credit, but it does include Social Security benefits, and it also includes unemployment benefits. So, who is the poor among this population? Tragically, children are disproportionately poor. And when we look at the population of children who are poor, it's about 16 million children in America. And even more unsettling is the youngest children, under 5 years old, are disproportionately poor. When we talk about the percentage, about 55% of all children live at the 250% of the poverty threshold level. This is more children living in poverty than any time in America except 1962. And if you remember back to 1962, I can't that well, but that was right before the first war on poverty, when Lyndon Johnson appointed Sergeant Shriver to go to war on poverty. So what does the tax code do for anti-poverty relief? Social Security is actually the largest anti-poverty relief program in the country. It lifts out of poverty 15 million seniors and about 1.1 million children, as well as some adults who are not elders. So about 22 million individuals are lifted out of poverty by Social Security benefits. Tragically, disproportionately, the face of poverty among seniors is the oldest women among that population. So what about tax code for eliminating poverty, especially among children? As I said, the elephant in the room, the anti-poverty solution here, to the extent it's working, is the Earned Income Tax Credit. The Earned Income Tax Credit ties dollar for dollar anti-poverty relief to work. So this is part of our Work to Welfare program, or Welfare to Work program. How is the Earned Income Tax Credit doing? Well, the Earned Income Tax Credit, while it is, this is hard to believe, the Earned Income Tax Credit is almost 40 years old. It will celebrate its 40th anniversary it was enacted in 1976. In 2012, 26.5 million Americans received the Earned Income Tax Credit, $61 billion. The average refund was $2,200. And if we look at that, about 88% of that refund actually was cash coming back, not offsetting federal income taxes. It lifted 5.7 million individuals out of poverty, including 3.1 million children. By comparison, SNAP, or food stamps, lifted 4 million individuals out of poverty, including 1.7 million children. So what has happened with tax reform? Well, the good news is, in the most recent Tax Act, we did not lose the enhancements to the Earned Income Tax Credit that President Obama enacted, and those were basically increasing the Earned Income Tax Credit for families with 3 or more children, and mitigating to a certain extent the marriage penalty and the earned income tax. The good news is we did not lose those benefits, but they have only been extended through 2017. In addition, as we all know, Social Security benefits were not reduced, although that was certainly on the table to a certain extent. So my advice to President Obama, and my tax paper that will be published in the Symposium goes into a lot more detail about providing access to tax justice and many of the problems in the earned income tax credit, that while Congress can enact the earned income tax credit, we need to get it into the pocketbooks, and I say the pocketbooks of the working poor because the working poor don't have bank accounts typically. So we need to get that to them and let them keep it, not audit them to the extent that they have to pay it back with interest and penalties. So my advice, first piece of advice that I only have time to recount today is, please, President Obama, first, do no harm. We must preserve the anti-poverty relief in the tax code. While it certainly would be wonderful if these individuals don't have to pay, don't have to actually file tax returns and get their relief for the tax system and get it automatically by not having to pay regressive Social Security taxes, we're using the tax system to deliver these benefits. So let's first do no harm. Let's maintain and continue to improve the earned income tax credit. And please, Social Security benefits. Without Social Security benefits, about 44% of all seniors would live in poverty. We must preserve these benefits. And as John F. Kennedy said, if a free society cannot help the many who are poor, it cannot save the few who are rich. Thank you.
Thank you, Francine. Now we're going to hear from Dean Stark from UCLA.
Thank you very much. Michael, of course, is wonderful. We've heard how wonderful he is. But I also want to thank, especially as I begin here, my co-author, Eric Zolt, for not being here, thereby enabling me to blame him for any and all shortcomings associated. In fact, I think I have his cell phone number here if anybody wants it. So our project is a project that's in its infancy, really. As you will see, it very much peters out at the end. We've done a lot of digging in the data about the middle class, and we have some only very preliminary and tentative things to say about what we've discovered in this process. Our focus is really on two key developments in American economic life over the past several years. The first is what many people call middle class decline. This is meant to describe the economic stagnation and job polarization and diminished economic opportunities that are available to many middle-tier households, especially over the past 10 to 15 years. And then the other development that we want to focus on is the very substantial long-term reduction in the tax burden on the middle class over the past 30 years. And it's, in our view, considering these two things together sort of tees up a predicament that Congress and the President will face in confronting tax reform over the coming months and coming years. So let me start out with some data. When we talk about the middle class and middle class decline, I would really encourage you to take a look at this wonderful August 2012 study published by the Pew Center, The Lost Decade of the Middle Class, that really gives us a very nice snapshot as of that moment in time on middle class households. And I'd like to focus your attention here on a couple things in these figures. First, these are just sort of telling us who the middle class is. One of the things, if you get a chance to look at our paper, is that it's useful to think about alternative definitions of the middle class. This Pew study uses an approach that Tony Atkinson, in a paper on defining the middle class, describes this as an income boundaries approach. So if you look at those figures there, what you'll see is that 39,000 to 118,000, those boundaries represent 67% and 200% of median household income for 2010. So that's the main thing to point out, is that by reference to these income boundaries, the middle class can both expand or decline over time. It's not a fixed size. So that's just one kind of conceptual approach to defining the middle class. And you'll notice here that from 2000 to 2010, we have a reduction in the income of the middle class over that 10-year period. So let's take a little bit closer look at that. And here's where we see that the size of the middle class actually, they can't overflow. Are you there? My apologies. So, yeah, so the size of the middle class actually declined. This is a 30-year trend, a decline in the size of the middle class. Again, the size here determined by reference to the 67 to 100% figures. You can see it goes from 60% down to 50%. And that's a function of what many economists have studied, this notion of job polarization. That during economic downturns, we have a loss of employment opportunities, and then the recovery over the past 30 years, recoveries from recessions, have oftentimes featured what's sometimes called a jobless recovery and a polarization of economic opportunities, more opportunities in the upper class and the lower class, fewer opportunities in the middle class. Now, it's interesting to note here that even though what we're talking about is middle class decline, if you take a look at the changes in the lower tier and the upper tier, actually the upper tier is increasing more than the lower tier, right? So if you compare the figures for 1971 and 2011, the number of adults basically doubles for the lower income category, but it increases by a 2.5 in the upper income. So this is, again, just kind of setting the stage, giving you a little sense of how the middle class has fared economically over the past 40 years. Here's some figures regarding the median household income of the middle tier and net worth. Of course, what you're seeing there is in the 21st century, hardship evidenced here through some hard economic data. And then that perspective is shared, not surprisingly, by those individuals who self-identify as middle class. So one of the nice things about the Pew study is that it not only looks at a great deal of census data, they also have a survey where they ask individuals if they believe themselves to be middle class, and then ask them several questions, including this one: do you think a middle class lifestyle is harder to maintain? 85% believe that to be true. I'll skip over this in the interest of time. So the sort of second piece, on the one hand, we're looking at middle class decline. Seems absolutely certain that that's a phenomenon that we're going to have to reckon with. The second piece of our analysis concerns CBO data. And what I want to do is just sort of fly through three quick slides here. These are data that are probably familiar to most people in the audience. And we're going to look at income shares, tax shares, and average tax rates. And you can see here that the same trends that we saw in the Pew data are also evident in the CBO data, which is a skewing of the income distribution in favor of the top quintile. Of course, there's even a more significant skewing within the top quintile for the top decile, top 1%. But you can clearly see here what we were talking about before with the job polarization and increased income inequality over this period of time. However, the figures are not quite as dramatic as we saw in the Pew study, because here we're using what Tony Atkinson refers to as the fixed size approach. The middle 60% doesn't change in its relative size compared to the, it's 60% is 60%. So we're not talking about a diminishing number of households over time, unlike the Pew study. Now compare these reductions in income shares, which you can see is roughly, it depends on whether you look at 2007 or 2009. That's why I put that in there. But it's 8 percentage points, 4 percentage points down for the middle 60. And then we look at the tax shares, and the tax shares are substantially lower than what we saw in the reduction of income shares. So it's not surprising, of course, that the tax share of the middle class would decline, given that it's experiencing a declining share of overall income. But these reductions in tax shares are far in excess of what one would expect merely by virtue of the declining share of the middle 60%. Right? And then we look at average tax rates, and you can see some even more dramatic figures. For all taxes, an average tax rate of 18.3% in 1979 down to 11%. And then look at the income tax, 7.2 in 1979 to 1.1 in 2009. So what we've seen over this 31-year period is a very substantial structural reduction in tax burdens on the middle class. And that to us presents this sort of predicament or dilemma or difficulty that policymakers are going to have to face in confronting tax reform. This is the phenomenon, I think, that beautifully captures this nice little cartoon here that Larry Bartels includes in his book, in his article, Homer Gets a Tax Cut. Really what we've been talking about over the past 30 years is middle-class tax cuts have been the political grease that make possible tax cuts for the top quintile. Middle-class tax cuts, these data seem to suggest, are durable. Tax cuts for the top quintile come and go. We've turned our backs on tax cuts for the top quintile in the Clinton administration and then most recently with the fiscal cliff legislation. But those tax cuts for the middle class, we don't really repudiate tax cuts for the middle class. Once they're there for good. And our question, this is what we're struggling with at this point, and this is the point at which I will, in 60 seconds or less, make a few outlandish statements, is that the time may have arrived when we really need to reckon with this notion of middle-class tax relief. It's hard to imagine a more popular 4 words than middle-class tax relief. But in our view, this is a long-standing bipartisan festival that is worth reconsidering at this important juncture for the American fiscal system, in part because of concerns about the long-term fiscal stability of the country. That's argument number 1. Argument number 2 is a point about political arguments in favor of shared sacrifice. Frankly, I think a lot of the tax reforms that we would like to see that would raise revenue on the top quintile or the top decile, things like carried interest, for example, those things politically are incredibly difficult to accomplish. But once there is a credible possibility of a substantial increase in middle-class tax burdens, then we might start to take seriously some of these other reforms affecting high-income households. And then finally, I think this is an underdeveloped point, and I'm already over my time, but it's worth thinking harder about how changes in the tax system over the past 30 years may have actually contributed to price pressure on the middle-class consumption bundle, especially for things like healthcare, housing, and education. These are the things that middle-class anxiety is sort of made of, and the tax system is partly to blame for inflation in those sectors of the economy. So thank you to Michael Wood. I want to give him a big hug when I see him again, and thank you all for hearing me out.
Thank you, Kirk. Next, do you want David? Do you want to go up there, or do you want to talk from your seat?
I'll just stay here.
All right, David's going to speak from his seat.
All right, so let me start by saying these papers were each really a pleasure to read. They're very well written, and they're really very accessible. So they all share a very common thread. Stated broadly, the wealthy are jumping ahead, the poor and the middle class are falling behind, and tax policy has a role to play. So let me start with Professor Lippman's paper. This is really two papers. So the first is a very pessimistic view, almost a diatribe against social injustice in America. So to add to some of the statistics that she gave and drawing from her paper, the United States is ranked 29 out of 31 countries in poverty prevention. 17% of Americans are afflicted by income poverty. The number of children living in poverty jumped nearly 30% in the last decade to nearly 16 million people. And in the first half of the paper, Professor Lippman urges the president to declare war on poverty, very much like President Johnson did 50 years ago. Okay, so that's the first half of the paper, and that's really, in a sense, a paper in and of itself. So we move to the second. The second half of the paper is a historic and ultimately optimistic view of the earned income tax credit with some very helpful and I'll say practical suggestions for its improvement. So the earned income tax credit, Professor Lippman explains, it's the largest cash assistance and most successful anti-poverty program in America. She identifies 5 specific issues with it. First, as she mentioned, not all of it is permanent. The fiscal cliff extended it over only to 2017. It requires low-income families to file tax returns that forces them to hire professional tax preparers, which is very expensive. The EITC beneficiaries are often audited. The benefits are paid in a lump sum, and these are people that live paycheck to paycheck, and it would be a lot more helpful if they received it like paycheck to paycheck. And she suggests some really very practical solutions to deal with these. Her primary recommendation is that the IRS should appoint a deputy commissioner for social benefits because there are very special issues with the EITC. The commissioner would develop a social benefit culture within the IRS, work with the Office of Tax Advocacy, reach out to taxpayers. She suggests that the EITC should be paid with each paycheck rather than a lump sum. The refund should be verified before distribution. And these all sound to me like very practical and good solutions. And I have 2 thoughts. First, reading the paper, I had a very hard time reconciling what is really a dark and deeply pessimistic first half of the paper with the largely optimistic and very practical second half. I personally would like to see more of the second half than the first half. On the second half, I'd like to see perhaps some discussion of possible criticisms of the recommendations and her responses to the criticisms. To me, who I don't have much experience in the EITC, these seem practical and feasible, but I did have some suspicion of the wool being pulled over my eyes, and so I'd like to, get some sense of the other side. I'll turn next to Professor Stark and Zolt's paper. So while Professor Lippman presented a very pessimistic picture of the lower class in America, Professor Stark and Zolt, they extend that landscape to cover the middle class, and we learn that the middle class is shrinking. Now, that's not necessarily a bad thing if it turns out, and indeed it does, that the middle class people are moving, more middle class people are moving to the upper classes than to the lower class. So as we learned from the slides, the middle class's share of income declined 17%, but the upper income group increased its share 17%, and the lower class just declined 1%. But we learned from the data that not all is rosy. So while the middle class did see a 21% increase in its average pre-tax income from 1979 to 2009, the top 20% jumped by 65%, and the top 1% jumped by 133%. So here we begin to see the problem, and the problem is income inequality. So while on average the middle class has improved compared to the upper class, the improvement is dismal. And you see this borne out in the surveys. So a full 85% of the middle class say it's more difficult to maintain their standard of living. They're very pessimistic. You can see why. So Eric and Kirk, next turn to taxes. We learned that while pre-tax income declined for the middle class, for the middle 20% by 1.1% from 79 to 2009, their average federal tax rate fell 41.3%. Now, at the same time, so that's a real dramatic drop. At the same time, while the average federal rate for the top 20% also fell, it only fell by 14.4%, much less than the middle class. So it allowed the middle class to capture a much greater share of after-tax income than pre-tax income, whereas the upper class had less share of after-tax income than pre-tax income. In other words, the tax code is redistributing from the high-income taxpayers to the middle class. So it seems from reading the paper that while the middle class is declining, that's not necessarily a bad thing, and we have this wonderfully progressive tax system that's doing exactly what it's supposed to do. Tax relief went disproportionately to the middle class than the upper class. Therefore, Kirk concludes that at least from the tax perspective, the middle class has had it pretty good. And because he thinks they've had it pretty good, because the upper class has just had a tax hike, and that much more revenue is going to be needed to maintain the country's social programs, they suggest, and this isn't so well developed, but they suggest that the tax burden on the middle class should increase to build a more robust safety net. So I sort of question this premise, and I'm not quite ready to accept their conclusion. Now, they look at income, and they look at taxes, and they conclude that the middle class has had it pretty good. When you look at Professors Caron's and Rapetti's paper, they look at wealth and not income. And when you look at wealth, you get a very different picture. There was one slide here that gave you sort of a sense of this. So between 1983 and 2010, the top 1% saw their wealth increase by 4.7%. The bottom 80% saw it plummet by over 40%. So why is this? Obviously a big factor is the crash of the housing market. But I think tax policy plays a part. I think it plays a significant part. So let's take one very simple, prominent example. So we all know Warren Buffett paid $7 million in taxes in 2010 on an adjusted gross income of $63 million for a tax rate of 11%, or if you count it on taxable income, 17.3%. So if you just looked at his income and the tax he paid, you conclude that he had a pretty good deal. He did better than his secretary, but at the end he paid a meaningful amount of tax. However, his Berkshire Hathaway stock appreciated by over $8 billion in 2010 and nearly $10 billion in 2012. And yet he paid no income tax on that appreciation. He's never going to pay any tax on that appreciation. So while his effective tax rate seems to be 17.3% of his taxable income, it is much, much lower than 0.1% of his economic income. So it's no wonder that the wealth of the upper class is increasing at such a dramatically greater rate than the middle and the lower classes. So I start with an entirely different premise than Kirk and Eric. So they believe that more tax revenue will have to be generated because the upper class now has a higher tax burden. It's time for the middle class to pay their fair share. I believe that before we begin to ask the middle class to pay their fair share, we have to do a much better job at ensuring that the wealthiest pay their fair share. And maybe that won't be enough, but let's start there. Okay, let me turn to Professor Brown's paper. So Professor Brown argues that despite the recent tax increases for the wealthy, our tax system is not nearly progressive enough. And she hypothesizes that the reason that the tax system favors the rich is because members of Congress are rich. And she calls for her 535 tax report, which will report on the income tax returns of the members of Congress. Now, she's focused on three specific exclusions: the employer-provided pension plans, reduced rate of tax for capital gains and dividends, and the mortgage interest deduction. But in her paper, she in fact argues that all deductions and exclusions should be repealed, all income should be taxed at ordinary income rates, and the tax rates for all taxpayers except for the very poorest should be cut by 10 percentage points. And she says these changes will mean a simpler and fairer tax code, and that the highest income households will pay a great deal more in taxes. So I'll start by saying that Professor Brown and I are like-minded. So we both believe that the tax system is not nearly progressive enough. And I also agree with her that the capital of the very most wealthy Americans is too lightly taxed, and that's one big reason for wealth inequality in this country. And I also agree that it would be helpful if we had a focusing event to start the dialogue. But I have my doubts whether it's Congress's own self-interest that's responsible for our tax system. So on Monday, CQ Roll Call published a list of the richest members of Congress. Of the top 10, 7 are Democrats, including John Kerry, who's worth $200 million. Nancy Pelosi, she's number 12, she's worth over $35 million. And to take these two members, I don't think they're acting in their own self-interest, but I bet they pay a very low rate of tax. And I also wonder whether a 535 report would have the effect that Professor Brown expects. So Mitt Romney's returns occasioned a lot of press, but it really didn't affect him in the polls. And I think the problem is that there's a lot of Americans, including a lot of low-income Americans, who sincerely believe that increasing taxes on anybody means bigger government, and that big government is this country's biggest problem. And I think those beliefs have to be addressed directly. Now, as per Professor Brown's recommendation that all exemptions and deductions be repealed and tax rates be reduced by 10 points, I think she should be careful what she wishes for, because I think it's going to have the opposite effect that she intends. She'd repeal the personal exemption and the standard deduction. She'd repeal the earned income tax credit, the child care credit. These are things that benefit low and middle income taxpayers. And most rich people, people earning $5 million or more, would trade away their deductions for a 10% point reduction in a moment. And so you just think about it. 10% of $5 million is $500,000. The state deduction for someone earning $5 million and living in New York City or California is worth about $250,000. And so I agree with Professor Brown that we should increase the tax on capital gains, but I think I might do it in a little different way than just increasing the rates. So I think the real key, as some of you know, the real key to denting income inequality is really to dent wealth inequality and tax the wealthiest people in a manner, on the wealth that today is untaxed. So I've suggested a mark-to-market system for the wealthiest 0.1% Americans. It would raise $2 billion from Warren Buffett in 2012 alone. It could raise several $100 billion over 10 years, and I think that's the only way we're going to start moving to what is truly a progressive tax system. If that's too radical, I think you could really do something by eliminating the basis step-up at death and taxing the appreciation of gifts to charity.
David, thank you very much. Last and certainly not least, we're going to hear from Bruce Bartlett.
Well, not being an academic, or I'm not particularly interested in theory, I'm more interested in the reality of the political process. So I'm going to talk mostly about that. I was intrigued by Dorothy's talk about the potential impact of how taxes on the actual taxes that members of Congress pay on their own incomes might affect their view, or a world view, so to speak, about taxation. And I like her suggestion, but I would go even further. I would make it a matter of law that every member of Congress has to release their tax return. I don't see, of course this is an intrusion in their privacy, but they have no right to be a member of Congress. If they don't want to release their returns, then don't run for Congress. And furthermore, I think that this is potentially doable, because I think there's another reform that is absolutely essential and very doable, which is we should never again have a nominee of a major political party who has not released at least 5 years of his tax returns. I think it's just an absolute scandal that Mitt Romney got away with not releasing his returns. It isn't as if he didn't know he was running for president, for Pete's sakes. He'd been running since at least 2008. He should have released his returns to at least back to 2008. And I think it's just absolutely a scandal that this was not viewed as a scandal. I mean, it was just utterly irresponsible. So I like Dorothy's idea, and I think it should be developed, but go even further. I liked Francine's discussion of the earned income tax credit, but I would put a political dimension on it, because one of the things that motivates Republicans animates them a great deal these days is the idea that half of all tax filers, and of course they never quite say it that way, but that's the right way to put it, people who file tax returns, close to half have no federal income tax liability. And of course Republicans think this is just terrible. I mean, it's just terrible. The poor are not paying taxes. And I constantly have to keep reminding them that it was Gerald Ford who created the Earned Income Tax Credit. Ronald Reagan expanded it on many occasions. And the other major, and that's the major factor for why so many people don't pay federal income taxes. And then the Gingrich crowd created this refundable tax credit, which bumped up very substantially the number of people paying no federal income taxes. So it's entirely Republican policy, conscious, deliberate, intentional Republican policy to take as many people off the tax rolls as possible. And Michael will remember that one of the things that Ronald Reagan said in his signing statement to the Tax Reform Act of 1986 is he said, we are creating a vast degree of simplification because so many people have been removed from the tax rolls. You know, and this is another Republican idea that if you're not paying taxes, you are per se dealing with a very simple system. Well, guess what? Try to fill out the earned income tax credit forms yourself. They're damned complicated. And so just because you're not paying income taxes doesn't mean you have any degree of simplification in your tax life at all. Now I want to congratulate Kirk and Eric for treading where very few are willing to go, of stating that the middle class is undertaxed. I agree with this completely. But I also agree that we need to soak the rich a lot more too. And this is one reason why I become very strongly supportive of Michael Gratz's tax reform proposal. But I come at it from a little bit of a different point of view. I'm very much convinced that we have to have a very substantial increase in the tax GDP ratio in this country. Since nobody else wants to admit that, I keep saying it to kind of fill in the gap. But I do believe this. I think it's very, very unrealistic politically to bring people who are not in the income tax into the income tax. I think that's just unrealistic. The only way you're going to get these people who are not paying federal income taxes or to raise the tax share paid by the middle class is through a value-added tax. Now, why Michael doesn't want to use the word that, I'd be curious to know. But we can call it a goods and services tax, as they do in Australia and Canada, and that's fine with me. I don't care. It's a political question. Now, personally, I would just institute a VAT and use it for deficit reduction. I'd be the only person who would ever vote for that. So realistically, it's going to have to be done as a reform, as a revenue-neutral reform, and I hope Michael gets support for his idea because I like it. Because I think that one of these days, we're going to have to do something far more meaningful than has been done on the tax side to deal with our deficit problem. I do think the politics of this is going to change eventually, because if you go back to, say, the 80s, the deficit reductions and tax increases, Ronald Reagan signed into law 11 major tax increases. He signed into law the largest state-level tax increase in American history when he was governor of this state. I think the politics will change if economists know anything about what the hell they're talking about, i.e. that eventually interest rates and inflation will rise from their current abnormally low level. And once a politician can promise that deficit reduction will potentially improve the lives of citizens by reducing interest rates, by reducing inflation, that is what drove the deficit reduction plans of the 1980s. When that happens, there may be the potential of doing something meaningful on the tax side of the budget. And so, one last thing I wanted to mention to Kirk is that I would try to work more with the poll data, because it's the self-identification that people have with their social class that's really important economically. And it's quite remarkable that the polls are very consistent that there are no rich people in this country. Nobody thinks they're rich. I mean, seriously. And there's some good historical data in the General Social Survey, if you haven't looked at it. The New York Times has done some good polling on this. Talked to David K. Johnston. He led a big project that the New York Times did that did some interesting polling. They did some in-depth polling. I do think that the wealth component has to be brought into this, although I don't know how. The data that we deal with mostly comes from the Survey of Consumer Finances. It's not very good, but one reason why I would support a wealth tax in this country is just so we could get the data. I'm sure that's not a widely shared good idea for doing anything, but nevertheless. So I think I'm just going to stop there. Thank you.
And by the way, thank you all. Thank you, panelists. Thank you, panelists.